The surprise news this morning out of Samsung here, surprise guidance or profit warning here. What's not a surprise, though, I have to say, we saw this bus coming from a mile away, this inventory correction in the chip space here. What I want to know is how long the correction lasts.
Yes, good morning. Thanks for having me on your program. We think the inventory correction will last until end of 2Q or early 3Q. We are already seeing signs of inventory consumption by hyperscale and smartphone customers. So inventories are gradually starting to come down, but I think it's still going to take about a quarter or quarter and a half for inventories to start coming down.
Sanjeev, I'm just curious because last week everybody was talking about how chip stocks are bouncing back. We see this kind of tech rebound. Why do you think that Samsung is coming out with this profit warning now? I'm just interested to see, are they going to have to basically cut production here, along with what Micron talked about earlier this week?
Yes, so last week, chip stock had a big rebound, and that was because Micron announced 5% cut to its DRAM and NAND production. So that's usually a bullish sign, especially when the industry is saddled with a lot of inventory. But Samsung's 1Q guidance is in a way backward-looking. Micron's production cut will have impact on chip inventory and prices a few months down the line, whereas Samsung's this quarterly guidance is about 1Q. In 1Q, memory prices plunged on an average 25%, and that has affected their performance.
Sanjeev, can we attribute all of this to the semiconductor side of the business, or is it essentially company-wide?
This is mainly semiconductors, and this was well known. But the weakness on the company display business was not as factored well into the consensus estimates. Display is about less than 10% of the company's earnings, but in this quarter, display business is likely to make a loss, first time since 1Q of 16, and this is because LCD panel prices fell by more than 10% in 1Q. But then also on the OLED business, which is a big supplier of OLED screens to Apple and other smartphone makers around the world, the utilization plunged because of weak demand from Apple and weak demand for smartphones in China. So utilization of its flexible OLED fabs in particular took a big hit, and that's one of the main other reasons why earnings are going to be below consensus expectations.
Right, that's 80% of the business, chips plus LCDs. Oh, well, 80% of operating profit, just to be specific here. So talk to us. What damage do you see now to earnings, essentially? What do you think Samsung's going to say in a couple of weeks?
Yeah, it's very clear that, after DRAM and NAND prices plunged on an average 25% in 1Q, we think prices are going to fall another 15 to 20% for DRAM in 2Q and another, let's say, 5 to 10% in 3Q. So, yes, overall, we are expecting Samsung's earnings to remain pretty weak in the near term. But in the second half of the year, because of demand seasonality and production and capex cuts that several memory suppliers have announced in the last couple of months, I think we will see some impact of those, and demand-supply situation is likely to get somewhat better. So yes, I mean, first half is likely to be pretty weak, but we see a recovery in the second half driven by seasonality, and also the pace of ASP declines is likely to moderate.
Right. Sanjeev, I'm just wondering, when it comes to Samsung, I mean, I guess when it comes to supply chain, a lot of it is very much Samsung focused here. So does this have a less of a wider impact when it comes to some of the other companies that you view and you look at as well? I'm talking about, SK Hynix or some of these other Korean tech names. Are we going to see more of a knock-on effect?
Yes, so it's pretty clear, so both the companies are affected. Like in case of Hynix, it's pure memory maker, so all they do is DRAM and NAND. So they will have a bigger impact from this price declines on their profitability, I mean, in terms of YOY or quarter-on-quarter earnings decline. And, yeah, this will continue for the time being, at least until 2Q. But because of the demand seasonality and new model launches by smartphone makers, as well as a return in demand from hyperscale customers, we think things will start turning better for these companies from 3Q. So we are expecting 2Q to be bottom of earnings for Hynix.
The smartphone side of the business is also going to be hurting, isn't it? And this is as we got data coming out of China from the China Academy of Information and Communications Technology suggesting that we've got a near 20% fall in smartphone shipments in February. In fact, February, and you know, we can talk all we like about there being a holiday in the Lunar New Year, but even if you discount that, it was the worst month for smartphone shipments in China, would you believe it, since 2013. Are the alarm bells ringing?
So indeed, yeah. I mean, the Samsung's memory business will definitely take a hit from this because they supply DRAM and NAND to pretty much all major Chinese smartphone makers. But for Samsung's own smartphone business, their share of the Chinese market is less than 1% as of like end of last year. So, you know, the weakness in Chinese market is not really hurting them at the moment. And if anything, the new Galaxy S10 model that they launched earlier this month, it's actually, shipments are trending somewhat better than our expectations. So initial response for that model in Korea, in China, and in the U.S. has been pretty good, but we need to wait and see.
If they pull back on CapEx, final question, does that mean there's a possibility they up the dividend? That's going to keep more cash on the balance sheet. Very quickly.
Yes, definitely. We think less CapEx means more money for the shareholders, and we are awaiting announcement from Samsung in this regard in July, as the company has promised.